So let's dive into a concrete example to see what's the better investment, RRSP or TFSA. So let's take an example and make some assumptions here. Let's assume you're 40 years old, and let's assume you're going to retire at age 65. We're putting $10,000 per year in an RRSP, and let's assume a fairly conservative investment return of about 5% per year. And let's also assume furthermore that we're just starting from scratch and we have $0 in our RSP account. Let's see what happens. So if you can see the chart here, and I've summarized it at the bottom right here, after 25 years of putting $10K each year and making 5% return, you've got about $477,000 sitting there for you at retirement, of which case you can use to help live a better life, travel, and do stuff. But wait, there's more. So let's keep in mind that this is an RRSP, which stands for Registered Retirement Savings Plan. And essentially, any monies earned within this account is growing tax-free. Now, if you're in about a 30% tax bracket and you're investing this $10,000 per year, when it comes time to do your taxes, you're going to save about $3,000 per year. That's either going to lower your taxes owing, or it's going to increase your refund by $3,000 in this example. Now, if you take that $3,000 and actually reinvest it back into your RRSP, assuming the same 5% return per year, well, after 25 years, this $3,000 just in contributions alone is an extra $75,000. But remember, it's growing each year at 5%. So now what we have after 25 years on this $3,000 extra that you've reinvested after you got your tax refund, this has now grown into an extra $140,000. So tack that on to the original $477,000 that you have earned, and you're looking at 477 plus 143. You're looking at $620,000 that you have at age 65. Now, just before we jump into TFSAs, I hope that you are finding this useful and informative. If you are, please hit that thumbs up and subscribe so that other people can enjoy these videos as well. Again, it's free to subscribe, free information. Now let's jump into TFSAs. So let's take a look at what is a TFSA. It stands for Tax-Free Savings Account. Basically, it's a way for Canadians to contribute money into an account up to a certain limit per year, and it's tax-free. So it's not tax deductible like an RRSP where it lowers your taxable income. However, it is a completely tax-free shelter in the sense that if you open a tax-free savings account and invest, whether it be in bonds, dividends, stocks, mutual funds, any interest earned on those investments or capital gains is not taxed at all. So this is a huge advantage and definitely is worth looking into as an investment growth vehicle. Again, there are limits of, right now the limit is $6,000 you can use per year. You can use unused contributions from previous years to actually contribute extra in the current year. Okay, Rick, I get the point. Now I know what an RRSP is versus a TFSA. And you know what? Maybe you learned something new so far Or maybe you already knew all this stuff. That's fantastic. Now that we're on the same page though, let's try to answer this question: which is better? That depends on factors such as time horizon, what your plans are for the money, and what stage of life that you're at. I will say this though, generally speaking, I think that at some point you should accumulate and take advantage of both. They both have tax advantages, and let's face it, that's something that we're always trying to minimize taxes because we pay too much taxes as it is. So when we have these vehicles of either tax deferred or tax sheltered growth, we should take advantage of them. TFSA, you have a $6,000 limit max per year for now. RRSP depends on a percentage of the income that you make per year. So you've got to look at what room you have left in contribution and look at it that way. There's also different strategies. So one strategy could be invest, for example, $10,000 in RSPs per year, and then take that refund in the example that I gave earlier of that $3,000 and put that into a TFSA. So this way you have both. So down the road, no matter what circumstances life throws your way or what stage of life you are at and decisions you make at that time, you have a couple of options to use those funds. Again, the main idea for RRSP is for that tax sheltered growth. And the idea is that you start withdrawing from it when you're retired and not making any income, so that you're not paying that much tax as you withdraw it each year. Whereas, for example, if you took it out now and let's say you make $60,000 or $80,000 a year, and then you took $20,000 or $30,000 from an RSP right now, that would get added to your taxable income. So you'd be, for that extra money, you'd be paying at the higher tax bracket. So it kind of defeats the purpose unless you're leaving it in there for the longer term. Of course, there's exceptions to this, like the home buyer's plan where you're buying your first home. There's eligibility requirements for that. I encourage you to look at Canada.ca, the CRA rules and guidelines for that, or speak to your accountant on how that all works. But that said, the TFSA, not very many restrictions on it or rules. Essentially, that's that any dividends, income, or capital gains earned on that money is tax-free. You can have that money and withdraw it with no penalties or tax implications. So again, hope you've learned something, or at least open things up for discussion with family, spouse, or your accountant or investment advisor, because that's what I'm trying to do here, is just share some of my experience and learnings from the past to help you make better decisions in the future. And again, helping to build your wealth. That's it for now. Take care.